Inflation is way above the Fed's target. Oil prices are high, which is inflationary. Oil is in everything. So when it goes up, the CPI numbers and all the other related numbers go up too. And that would, in normal times, lead the Fed to raise interest rates, to lean against the inflation that we're seeing now, so it doesn't become embedded and become expected. And then when inflationary expectations surge, then everybody starts front running, so you get the potential for the financial system to spin out of control. Historically, the Fed has leaned against that. Okay. But the new Fed chair obviously went through some kind of a job interview process before he got the job. And that job interview, no doubt, involved Trump or some of his surrogates saying, listen, we need lower interest rates, right? You get that, right? You're going to lower interest rates if we give you this job. And Warsh saying, yeah, of course. I'm glad to do that for you, Mr. President. So I think there's kind of an expectation that we're going to see easier money going forward at some point. While right now there's pressure on the Fed to raise interest rates, or at least not cut them. And we'll see if they subvert our expectations here and do something serious with half a point of Fed funds rate or something, one way or the other. But more than likely, they're just going to sit there again. That's calming in the short run, but in the long run, current interest rates are already too high for the current financial system to function, because already interest costs on government debt around the world are soaring. The U.S. is up to like $1.6 trillion a year in just interest on its debt. And we haven't even rolled over all the debt yet at higher interest rates that is going to roll over. So the interest cost on U.S. debt is going to continue to rise. And that can be debilitating because we have to borrow that money. And that means, we're running a defense budget of like $1.5 trillion a year right now. And interest is going to be that same number or higher. And that guarantees massive deficits going forward, which we, of course, have to borrow, so that increases interest expense, which increases future deficits. And that could become a death spiral very easily. I would say that you could make the case that we're already in that kind of a death spiral when we are a global military empire who has to borrow to fund our defense budget. And when interest costs exceed your defense budget, you're reaching the point where your currency is no longer going to function in the way it has in the past. So, I think we're definitely headed for that kind of a scenario if we're not already there. And that should be terrifying to anybody who is interested in financial stability, because it inevitably leads to chaos out there. And whether it's this year or 2 years from now, I don't know, but we're definitely headed that way.
The scale here is genuinely staggering. The U.S. now pays roughly $1.6 trillion a year just servicing interest on its national debt, a figure closing in on the size of the entire defense budget. As older debt matures and gets refinanced at higher rates, that interest bill is only set to climb further, which deepens future deficits, which in turn demands even more borrowing. Critics call this a self-reinforcing spiral. When a global military power's interest payments start rivaling its defense spending, it's a sign the currency system is running up against structural limits, whether the actual breaking point hits this year or further down the road.
Feelings first, we had a really nice run for a couple of years, and a correction is inevitable when you double or triple. It just creates a lot of people with profits to protect, and they protect them by selling a little bit, and then other people see that and get spooked, and so on until you get a nice correction. And this has been a pretty serious correction. But the underlying, as I said before, the underlying trends and fundamentals are still great for gold and silver, because governments are borrowing way too much money and they have to inflate away their currencies in order to cover the interest expense that they're generating. So easy money is basically a given, and that'll be fine for gold and silver going forward. That's going to work out just fine for those guys. In the very short run, you got seasonality. This is normally the boring time for gold and silver. And, it happens over and over again. You have this great December, January, and February stretch where gold and silver catch a bid, they go up, the mining stocks spike, and then everybody jumps in and they think, okay, this time fundamentals are going to overwhelm seasonality. And they don't, you have 2 or 3 really boring months for precious metals. And we're in what is historically that stretch. So you put those two together, a nice run that inevitably calls for a correction and the boring stretch of seasonality. And this is kind of what we should be expecting, I think. Now, that doesn't mean that we're going to flatline here. Gold and silver could still go down from here, or it could turn around and start rising from here. But, as far as this being anything unusual that's happening right now, this is very typical for basically any market that has a good run and has seasonality. When you combine those two things, you get boredom. And so it's not a surprise that we're living through that right now. Now, the good part of the precious metal story is that the prices have remained high enough to generate tons of free cash flow for the miners. So we're just at the very beginning of another earnings season that's going to have pretty good numbers. Newmont has already reported, and it had $2 billion and change in free cash flow. When big miners start generating that kind of money.
Free cash flow.
Free cash flow. That's right. They funded their capital spending and still had that much money left over. And that means that the other big miners they probably won't generate the numbers that Newmont generated, but they'll generate good numbers for their size. And that will leave them with an even bigger pile of cash. First quarter numbers were phenomenal. Everybody generated a lot of free cash. And now they're generating more, not quite first quarter numbers, but more. And that allows them to do a lot of good things for themselves. They can pay off their debt, they can raise their dividends, they can buy back stock, and they can make accretive investments via acquisition. So expect all of that from the big miners who are generating free cash flow, and note that makes them better companies. No matter which of the things I just listed they decide to do, it makes them better. If they pay off all their debt, that's great. A debt-free producer with free cash flow is a really good investment. And if they buy back their stock, that makes all the per share numbers go up, and if they increase their dividend, of course, it sends more capital back to investors. So that's going to be basically the story for the gold and silver miners in at least the next 6 months, and probably for the next 5 years, where they're going to be making a lot of money. They'll be doing interesting things with that money, and gold and silver miners will start showing up on momentum charts and value charts, maybe at the same time. So I think that as an industry, there's a lot of value still out there, and a lot of these companies are still buys at current levels.
After a strong multi-year rally, gold and silver have pulled back, and analysts say that's less concerning than it might look. Sharp run-ups naturally invite profit-taking, and late autumn has historically been a seasonally quiet stretch for precious metals, before renewed strength typically returns between December and February. The underlying thesis stays intact. Heavy government borrowing continues pushing toward currency debasement as the politically easiest way to manage debt costs, a dynamic that consistently favors gold and silver over time, even through quiet, unremarkable stretches like the current one.
Well, the bond markets are spooked, definitely in the US and also more so in Japan. You're seeing Japanese rates go from 0 to approaching 3% now. At the long end of their yield curve. And that, if you want to talk about interest expense, if they have 260% of GDP in debt that they're paying interest on, and the debt is now 2.5% or 3% or whatever, you're talking a major chunk of GDP just in interest expense. And what that does to the yen carry trade might be another big story for the year ahead, because for the past decade or so, Japan has had unnaturally low interest rates, which have allowed people around the world to borrow yen at next to nothing, convert those yen into dollars and collect 3 or 4 or 5%, or Brazilian debt or whatever and collect 6 or 7% and make this massive spread. That's kind of dying right now. And that means there's a lot of paper out there that has to be rolled over, but no longer can be because the numbers don't work. And we really don't know where that is. We don't know who owns the biggest part of yen carry trade deals, and we don't know what's going to happen if they can't roll them over. So this is the kind of thing. It's sort of like the private credit thing, where we don't know what's going to blow up, but we're seeing things start to not work anymore. And we don't know how much bad paper there is following on the thing that's going wrong today. So, we'll see. But I think the risk involved in the death of the yen carry trade and, the blowing up of some parts of private credit, these are big numbers. And they're huge problems when and if they happen. And if they happen together, forget it. It's the government in the U.S. in particular ends up doing another $3 to $5 trillion bailout, and then the bond market says, "Oh, I didn't even like dollars before they did this bailout, and now what?" So that's all out there, kind of, sort of waiting to happen in the next couple of years.
A parallel risk is building in Japan, where long-term bond yields have climbed from near zero toward 3%, a dramatic move for a country carrying debt equal to roughly 260% of GDP. For over a decade, ultra-cheap yen fueled a massive global carry trade, letting investors borrow yen for next to nothing and reinvest it in higher-yielding assets elsewhere. As Japanese rates climb, that math is falling apart, leaving an unknown volume of leveraged positions that may not be able to refinance. Combined with stress already building in private credit markets, it's a setup with real potential for a large, unpredictable shock.